Turning to how all of this affects the current environment for deals. Private equity firm Thoma selling its remaining stake in the Nasdaq for more than $3 billion just this week. The company completing exits representing $20 billion over the past year, and the combined value of its acquisitions also reaching nearly $20 billion in that time. Joining us exclusively is founder and managing partner Orlando Bravo. Thoma manages $179 billion in assets. It's good to have you here. Welcome.
Sarah, thanks for having me. Good to see you, Carl, as well.
So on the Nasdaq sale, that comes off of a deal that you did with the Nasdaq, selling that stake. Is there anything to read into the why now?
Not at all. We had a great deal with Adenza, one of the highest quality companies we've ever owned. We sold it to Nasdaq, and actually Adina at Nasdaq was very brave at the time. It was at a time when the market has just dropped a lot. There was a lot of pressure on the stock, and she had a strategic intent in terms of buying the business. We sold the business, and as part of the deal, we got a portion in stock and a portion in cash. And over time, we have sold that stock. But we are very bullish on Nasdaq, and there's nothing to read into it except we're a private equity firm, and we're not meant to hold public stock for a long period of time.
Of course.
We just have to do it carefully and support the companies, but over time, we have to sell those.
So what are you doing right now? How are you looking at the environment?
What we're doing is we're busy.
I know, it's not a good one. I mean, you got credit.
I don't think I've slept in the last year. This is the hardest I've worked.
Why? What are you doing?
In the last 12 months. Well, you said it in your introduction. We distributed back to our LPs $20 billion in cash in 12 months. This doesn't happen just magically. The phone isn't ringing with buyers just looking to sell companies all of a sudden. You have to work on it. You have to call the buyers. Now, if you have the highest quality companies that are hitting their numbers in this environment, people can underwrite those and they can buy them. So we focused on that. And then buying, we've bought $20 billion worth of companies, including the Jeppesen deal recently for $10.5 billion.
We're looking at some of the big ones in the past year.
So we have been, extremely busy. And look, the point is, and you were having that conversation before, in private equity, our peers are too focused on the macro. The fact is, there is so much liquidity in the market from private credit, from private equity. People are underinvested as well in the private markets. And the world is full of high quality companies that can be improved by good owners and with good operations. And we just put our heads down and we focus on that. And that has made us, really, really busy when many others are not yet.
But you just said the ability to hit your numbers in this environment. Is that a challenge? Is that a small sample right now, given what we have in the macro?
That is, it's such a good question. It's a challenge, and that's where operations come in. See, in 2021, in our sector in software, there were so many bad managerial practices, and some that people couldn't control, right? People had to work remote, so you lost a sense of culture. Maybe you oversold to your customers, and now there's a lot of volatility in some of those companies' numbers. So it's very difficult to expose them, because a buyer, when they're going to pay these kind of prices, you need stability and you need to be able to underwrite it for a long period of time, but especially for today. If you cannot underwrite the next 9 months, you cannot do the deal. Now, when we have quality companies, those are the types of companies you can sell, and those are the types of companies you can buy. When we bought Jeppesen, of course, the macro was challenged. You talked about geopolitics and policy, but we could underwrite that company and its cash flow for a long period of time.
You deployed a lot of capital during, 2020, 21, that sort of period, right? And that was a challenging period.
That is true. But going back to Adenza, if you chart the Nasdaq, we combined two companies to form Adenza, and they were done at the market peak. But we still had a wonderful outcome, because all we care about is how much did we pay, did the companies hit the numbers that we underwrote, and is the exit multiple still valid? And it is. We don't buy the index in our industry, and we don't sell the index. We buy a specific company, and those are the three things that you can control and that matter in an investment. It's also interesting that 2021 period when we were super busy, there were some of our investors would say, "Oh, you bought at the peak. It's not looking good." Well, now there's another peak. If you charted, it looks pretty good, actually. But
so you're not worried about monetizing them in this environment?
It's largely where you buy versus the Nasdaq, a specific company, as an owner, is largely irrelevant, actually.
So a big part of our conversation this week has been signs that the capital market's coming back to life, right? We got some M&A, we've had a couple IPOs. Is it your sense that the period can be sustained beyond this 90-day deadline or whatever we have on trade? Or is this a limited window?
It's going to be a slow year of M&A. And there was a big deal announced today, and of course we've announced some, because it takes a while to expose a company, get buyers interested, and selling it. And the pipeline right now is quite low. So it's going to be a low year. It's not going to continue for too long, in my view. There's a lot of money out there, and people need to put this money to work. Give you an example in private credit. When we financed the deal, the Jeppesen deal, the carve-out from Boeing, it was about a $4 billion financing. We had the financing arranged. The day the deal's announced, our capital markets group got a call from 70 private lenders. 70. That is just unheard of in my 25 years in private equity. And we were able to get an even better outcome on that. But there's how much liquidity is out there.
It also speaks to how crowded private credit has gotten.
It really is. And it's a wonderful opportunity for private equity because the spreads are much lower than they were before.
So what excites you now? You've been tech-focused, software-focused. What about the evolution of AI? What's most exciting to you right now?
Oh, that's incredibly exciting. See, in software, we have lived through step function increases in terms of the industry's power and relevance in the corporate world. The first huge one happened around 2010 with software as a service. That created this boom that you're seeing now. That is still left to be played out. Over 50% of corporate applications are still on premise. So we still haven't gone through that whole wave. Now you have AI. We used to tell our corporate customers on behalf of our companies that ultimately every corporation needs to become a software company from a core competency standpoint. Now we're telling those customers every company needs to become an intelligent software company. Two important things that excite us that we've been investing heavily on. One is software companies that own the customer data and that have permission to use that data. You take Coupa software, which you've reported on it before, 5 trillion supply chain transactions they've processed. The ability to mine that data and put it in predictive, powerful analytic models for that data gives us an enormous AI runway, and we're investing heavily under it. Cybersecurity. The new word in the last 6 months is agentic. Everybody's talking about all these agents. Now imagine with identity in cybersecurity, being able to secure the identities not only of individuals, but also of all those agents that are going to, be built.
Who's doing that?
Over time. Well, we have two companies that do that. One is SailPoint, which we owned before, took public, owned again, and was a relatively recent IPO. And we have Ping Identity that secures identity. That's a really important part of cybersecurity that we've been investing heavily after is identity management. There's a great third area, the Office of the CFO. And Anaplan provides great solutions it's a market-leading company that basically can redo a company's plan depending on any factor that changes. And with a changing geopolitical landscape, changing world, that's a very, very relevant company today.
I'm going to guess that you think the infrastructure build-out play also has room to run. Nowhere near getting over our skis.
Everybody's throwing so much money at that. You have on the one side, in terms of cloud data centers, there's still incredible growth and incredible appetite. That just continues on. And now you have AI data centers, which is a different way of building data centers because they don't need to be clustered necessarily, and people are building those and throwing money at it.
How will you know when that's no longer getting rational, that market?
We do enterprise software, and see, the value of enterprise software is you don't have CapEx.
Tariffs?
You're not a physical good, at least
exactly,
not yet.
Right.
And we hope it stays that way. And you don't have a supply chain. See, once again, software shows that it's a superior business model in times of real big distress or in times of big changes. You have all those recurring revenues and you have a simple business. Now, in terms of when do you feel that AI would be a little bit ahead of itself? When does it become a bubble? Our thing is, while it is transformative and we're investing heavily towards it, technology and AI in particular for corporate customers, which is where the money is evolutionary. It is not revolutionary. It's been now around for a while, and there's not a lot of revenue coming in from corporate customers for these applications yet. It'll happen, but it'll happen over time. You have regulatory risk. You have cybersecurity risk. You have to adjust to their processes. You have to get to the right use case. You have to get to the right ROI. And all of that with big corporations, it just takes a while.
But putting all that together, Orlando, don't you think that the market appreciates what you appreciate about some of these software companies during times of stress, some of these AI companies and the ability to mine data? Is it hard for you to find good companies that are public to buy because valuations are high in the space?
You are absolutely right. When we talk to public investors in terms of their appetite in our companies, the greatest investors, we think just like them. Investors think the same way. And if you look at software valuations today, if you're highly profitable, if you're growing above 15%, and if you have scale, you're trading for 30 times unlevered free cash flow, 35 times unlevered free cash flow, way in excess of the S&P numbers that you were talking about. That is about right. Those valuations are about fair right now. Our opportunity in the market, the private equity opportunity in this market, is that the average software publicly traded company loses money. These companies are not the best run for shareholders. They have a lot of opportunity. So if you're able to take them private and you're able to put up your operational playbook, whatever it is for a different firm, and get them to that rule of 60, rule of 70 in terms of adding growth to EBITDA, then you have very special companies that not only work for their customers, their employees, but they work for the shareholders, and they do that today. And that is what the market really, really wants. That's what the experienced investors with big money really want.
So there's opportunity.
You think there's something in the nature of being public that sort of corrodes discipline?
There's a bit of that. There's a lot of confusion because when you receive advice from so many shareholders that can tell you how to increase the stock price in infinite ways, it can get quite confusing. Do a share buyback. Why don't you grow faster? Why don't you dip your margin to grow faster? If we could do that operationally, if we could lower our margin to grow faster, we would do it. It just doesn't work that way. We also say, look, these companies, to their defense, they've done something great. I mean, the fact they get to 500 million, $1 billion in revenues and dominate a market, you have to really tip your hat off and respect that. However, they're young, so some of these managers have not had that many people to learn from. They haven't been in the business 30 years of having these great schools of management to go out and put together great operations with great growth.
So there's your clue. If you're looking for the next public company that Orlando Bravo is going to buy, money-losing company, despite what seemingly is high valuation, that needs help on the operating side.
You said it.
Yeah. Okay.
Hopefully not too many people copy that.
Well, thank you for joining us to talk through some of the big ideas in the environment. It's really good to have you.
Thanks for having me.
Orlando Bravo of Thoma Bravo.